revenue and customs are that the income coming in is going to be considerably less than forecast at the time of the budget. And this puts huge pressure on national finances. Furthermore, I think that the Treasury has seen an enormous number of negative points coming in. I mean, after all, everything she did in her budget was actually economically destructive. I mean, in a sense, you can understand her doing it because, she's backed by the trade unions. She's got people to pay off. She's also got a parliamentary party who is far left-wing and elements of it that are really left-wing. So she had to do the socialist thing, if you like. And I guess, anyway, she sort of thought that, the landed gentry, those nasty people chasing one thing, really, which you need to do, and that is cut benefits. And you got to cut, and they detailed the benefits to be cut. But there was an outright rebellion in the House about this because socialists are elected basically to protect and enhance welfare. That's their mission in life.
Yeah.
So, the government had to back off. Now, this means that we are heading for a sterling crisis because, quite clearly, tax increases are, the increase in tax revenue is not going to happen. The increase in welfare costs and also unemployment costs from an economy which is sliding into recession, I mean, it's just going to knock the whole thing sky high. And it puts the UK in a debt trap. And a debt trap, by definition, is a situation where the tax income to back the mountain of debt is growing at a slower pace or even retreating in the face of rising debt. The level of tariffs are now higher than they were at the time of Smoot-Hawley. We've just completely reversed all the progress towards free trade. But of course, I mean, we don't actually know the figures because, Trump keeps on changing the narrative. And, he's obviously not getting the agreements in on time. So he's sort of extending it, and throwing out things like, we're going to tax copper 50%, import, come on. This is economically destructive. It really is. And at the same time, he produces this big, beautiful, wonderful bill, another 3+ trillion of spending. I mean, the man's a spendthrift. And at the same time, he's telling the world that the dollar should be lower and interest rates should be lower in treasuries. That's going to happen. But they're not going to buy anything out along the yield curve. The only things they will buy are T-bills. 3 months, 6 months, a year at most, but most of it I would have thought 3 and 6 months. So what does that mean as far as the Treasury market is concerned? Well, it means that the average maturity, if you like, across the whole of the Treasury market is shortening, which means more and more of it has to be rolled over every year. So, we don't know how long it's going to take for this funding crisis really to hit. But if the funding crisis hits in the dollar, you can forget every other currency because the dollar is the king rat of currencies. At the moment the dollar is going down, I think there's going to be a switch. I think really what we're likely to see is an acceleration of the deteriorating position of credit over the rest of this year compared to where it was earlier than this year. It doesn't look good to me, I'm afraid, as far as credit is concerned. And the other thing which has everybody got wrong, and that is interest rates should not fall. Now, I can't say that the Fed and other central banks won't reduce interest rates, but they would be stupid to do so because all they do is they undermine the value of their currency. It's not going to help the funding at all. If anything, when you've got greater risk in credit, then bond yields, the coupons, the interest rate on that credit has got to rise to reflect that risk. It must do. Otherwise, nobody buys it. So, yeah, not good.
And the thing is that, as we've spoken about before, a lot of the people that are blinkered.
Yeah. I mean, What that ignores is another theme that I've been banging on about, which I think is desperately important, and that is the cycle of credit. I think it's quite difficult if you're in markets to really realize that you're in a credit bubble. The way to look at it is that because for every credit, there is a debt. You've got an obligation for every credit, okay? We're in a debt bubble. Now, that is unarguable. I mean, not just government, but also households, everything else. We are in a debt and therefore credit bubble. This was exactly the situation in the late 1920s. And that was followed by the Wall Street crash. Wall Street peaked out in September 1929 and lost valued relative to the long bond than it has ever been in history. It is more than twice as overvalued as it was in April 2000. The dot-com boom, more than twice as overvalued. If we see the long bond yield beginning to rise from here, you're going to get an equity market collapse developing, just like Wall Street in 1929. It's going to be another October 29. Now, I don't know when it's actually going to happen because everybody is asleep at the moment. You know, as I think we agreed before we went on camera, you know, so many people are either watching Wimbledon or watching cricket or out of it. So it's been controlling the market. But I suspect that's changing. And the thing that's interesting is that perhaps with a very quiet change of policy, I mean, we've seen it with rare earths, very good example. But we're now finding that, you know, silver, platinum, and so on. I mean, suddenly there's a behavior going on there, which we're not all that familiar with. Your comments, please. Cash flow pressures on mines are not as great as they were. So, you know, I think that, you know, the Citicorps and the UBSs from manufacturers are being given two fingers, basically, I think.
Yeah.
I think what you say is very interesting. There is another aspect to this which I want to explore a little bit with you. We had an announcement, rather I think it was a sort of, you know, monthly commentary coming out of the ECB about what had happened earlier this year with, you know, the premiums on COMEX and how it sucked in bullion and all the rest of it. And it was quite an interesting article, the way it was written, because it was actually trying not to say too much to upset the markets, if you like. That's the feeling I got between the end of October and the end of April. Yeah. On top of that, the LBMA lost a further 7.7 million for a total of 20,751,000 ounces.
Wow. Yeah, that's big.
It stands for delivery in that time. Interestingly, we're a bit over 22 million. 22,036,500. Now, okay, now you can't necessarily say that these figures are meant to match, but you can see that you've got a problem on one side and you've got a problem on the other side. Now, part of the problem, of course, is that the stands for delivery have increased at a faster rate this year so far than they have in recent years, sort of wider quadrillions and all the rest of it. The problem, of course, for the derivatives market is that many of the actors in the bullion markets are also acting in other derivative markets. So if you've got counterparty risk escalating in bullion markets, then you've got counterparty risk. As the amount of interest in the West is actually pretty low. And you look at COMEX and you see, as you said earlier on, you know, you've got 440,000 contracts open. I mean, this to me is sort of marginally oversold. I mean, how do you get something marginally oversold at the top of the market?
Yes.
There is another thing. It was reported on Kitco, and I had some Australian friends who were asking me about this. The report that the average portfolio from the sort of people who've got a bit of money, and I think the definition when you delved into it were people who had over $100,000 up to $2 million, that sort of thing. I mean, sort of, if you like, the affluent middle classes. And they reckon that something, I think between 11 and 12% of their portfolio was in gold or gold substitutes of one sort, forgotten that. And central banks don't get involved with it generally. I mean, PBOC is involved with it because they have the monopoly, if you like, of acquiring and disposing of the nation's silver. But other than that, no central bank is involved with it, or they certainly don't make returns showing that they hold silver as part of their reserves. But I can just see these shortages mounting. And as far as the West is concerned, I mean, the underexposure in portfolios is really quite shocking. I mean, you would normally expect in a balanced portfolio to see some mining stocks all similar, representing gold, silver, maybe platinum, or things like that, and maybe copper as well. But nobody's been interested for so long. And with respect to gold, I calculated that all over the world, if you look at, I think we got something like, and to a lesser extent, it was copper, though we forget that. I mean, you and I remember coppers, but and everything else, all the credit, including currencies, is incorporeal. In other words, it's nothing. It doesn't even exist other than an obligation in the future. I mean, this is why, if you look at the banknote, a Bank of England banknote, you get a script on it, which is getting smaller and smaller, I must say. It's getting into the real small print now. I will exchange this on demand for £1. What? No, it's now a £10. I mean, we don't have £1 notes anymore. Exchange this for £10, signed by the chief cashier at the Bank of England. And what he's referring to is £10 in currencies, if it is permitted. And at the moment, it's extremely hard to see how it's not going to happen. Is going to be absolutely devastating for everybody. I mean, it really is. The ability of government to provide the welfare for those who are suffering, those who are handicapped, those who have no work, is going to be extremely limited. The welfare is going to be worthless, and pensions will be worthless as well. So they won't be increased to take account of the devaluation of the currency at all. I mean, what I see, and I hope it doesn't happen, I really do. What I see is something that is going to be so terrible for communities, for individuals and communities and all the rest of it. And I think if I can get people to understand these dangers and understand...
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.